A very good evening and a warm welcome to Personal Finance. I am Gugulethu, Cele. Ever wondered whether or not you need to fix or not fix the interest rate on your home loan? Well, to tell us more about this, I'm joined in studio by Tommy Nel, Head of FNB Home Loans. So good to have you with us today, Tommy.
Thank you, Gugu.
Now, for many South African citizens who saw the interest rate hike that we had in July from our local MPC, many of them were biting their nails and considering, what does this mean for my home loan? And I was one of those as well who got an email to say, hey, just note that the interest rate on your home loan will be adjusted. But is this a good time to fix or not fix your home loan?
Gugu, those emails are never nice to get. Those emails that tell you, from next month you'll have to pay more. The question on when to fix is the age-old question, and the unfortunate thing is that there's no silver bullet. There's no crystal ball. You can probably get different guests that sit here every single evening, and if you ask many of them, you'll come up with different views, and that's kind of for me the different angle that I'd like to put on the table in terms of fixed rates. Is that one shouldn't try and beat the interest rate cycle. So. There's very few, even investment professionals, that can, get the market timing wrong more than right more than what they get it wrong. If they did, they would be sitting on an island somewhere, not having to need to work.
Tell me about it.
So for the average man in the street out there, the average consumer, to try and beat the interest rate cycle and call it better than what the market calls it is a virtual impossibility. So. I think it's a much better idea when considering to fix or not to fix is to really take a look at your own personal financial situation and to more look at it from a risk management angle. So I try and always liken fixed rates to more of an insurance type. It's obviously not officially an insurance product, but it's that bit of a premium that you pay that gives you that peace of mind that your interest rate would be fixed and your repayment would therefore also be fixed into the future. So I really don't think that people should try and time the cycle. The market consumes news instantaneously. So had there been an event in the Middle East and oil price doubles, heaven forbid, that would instantaneously start to reflect in the interest rate curves that the market uses to price certain instruments. And there's just no way that an average man in the street can actually beat the market on a consistent basis.
You're quite right. I'm happy you said that because it almost takes us 2 steps back to the initial affordability assessment process, where does this mean that before you go and apply for a home loan, which you potentially can't afford, should there be marginal increases in the interest rate, then you should maybe reconsider the amount of the home loan that you're looking at.
Absolutely, Gugu. So doing a budget is quite an art, and having been in credit for quite a long time, I get presented with customers' budgets on a daily basis, and I concede that maybe there's a different version that comes to the bank to what is really the case. But it's often surprising that you don't really see people making provision for unforeseen expenses, and saving for a holiday and saving for that car that might break on you, and actually keeping money separate so that if rates were to go up by 1 or 2%, you wouldn't stand the chance of losing your property. So I fully agree with what you're saying. One should actually practice a bit of restraint. If you, let's say, think that you can afford a repayment of 5,000 Rand, have a look at what interest rates could do, and try and maybe say, let's rather borrow only so much that if rates were to go up by 1% or 2%, that you can still also buy those luxuries. It's never nice if you just have to earn your salary and at the end of the month, a week before the time your money's out. That's not a nice way to live. So it's always better to leave yourself that bit of flexibility so that if rates go up, you can still maintain your payments on your home loan every month.
That's true. Having said that, though, should we, theoretically speaking, see the interest rate go up by more than 1% within the next year or 18 months, would it be advisable for someone who can or even can't afford it to go back to their bank and speak to them and say, look, I'm feeling the pinch, I can't really afford it, can we rearrange my payment structure?
So that's always a good idea, Gugu, is that banks are really not in the game of taking people's properties. That is the very last thing. So that's bad for the customer. It's bad for us. It's really not something we want to do. So we often look at it from a perspective of there's some bad things that happen to good people, and from our side, if a customer phones us up and says, listen, I've lost my job, I'm in the market looking for another job, and someone is fairly re-employable. Obviously, it becomes difficult if mining, for example, goes through a tough patch and people aren't reskillable or re-employable. obviously it makes it a very different kind of decision. But if a customer comes to us and says that they've lost their job and they need a bit of support from their bank, we look at it and we do an affordability assessment for the customer. Obviously, hope is not a strategy. So if we sit with a customer and there's just no plausible way of solving something, then it would actually be the best decision often to sell the customer's property, and we try and help them prevent the property from going on to sale and execution.
But even for that to get to that case, I take it takes quite a long process, right?
It does. So normally once you miss your third payment is when you'll go into the legal processes, whereby the bank informs you of the next steps in the process, and obviously just reinforces the seriousness of the situation. So there is quite a lengthy process, but I certainly wouldn't advise customers to avoid those calls when they come in. That's sometimes when when things don't go according to plan, is when a bank can't get hold of the customer and they seem to not be taking charge of the situation. So it's always better, answer those tough conversations, be honest with the bank, see what plan we can make. We really don't want to take people's properties back. At FNB, for example, we have a quick sell solution where we even try and sell customers' property before it gets to that stage where it now gets auctioned on the sheriff's front steps, because in that event you often get only around 50, 55, 60% of the market value of the property. So you can think that in that case the customer loses all the way, the bank loses all the way. So it's really what's good for the bank and good for the customer is actually quite aligned in this entire thing, and we want to make it work with the customer.
Tommy, just to sidestep for a moment, if I do lose my property because I couldn't keep up with bond repayments and after a year or two I managed to re-establish myself, I've got a proper job with proper income, can I come back to the bank and say, look, things are slightly better now, can you take off that black mark next to my name and maybe give me another loan?
Gugu, so look, there's no rule that says that if you've gone through a tough patch that the bank will never lend to you again. There's the term informal term of blacklisted.
Yeah.
In reality, there's nothing really like a blacklist. There's certainly there are credit bureaus that look at a consumer's treatment of his financial affairs historically, and if you had an incident where a bank, let's say, wrote off some money on you, but as a consumer again, you took responsibility for that bill, and let's say you did get another job. If you went to the bank and you settled that write-off, basically paid back that write-off, a lot of banks would look on that very kindly. The situation where a customer, let's say there's a write-off on a customer of let's say 100,000 or 200,000 rand, they then walk away from that completely. In two years they want to buy a property, but they didn't make good for their previous. Under those scenarios, banks are going to look at the client and really not be prepared to necessarily extend the customer further credit. But if you take charge of the situation and pay back the money that that was written off, and of course there must be somewhat of a story. So if bad things happen, you lose your job, certain unforeseen health things that can happen. So it's all about, I think, making contact with the bank and making sure that you're able to demonstrate that you've taken responsibility for the amount written off, and try and make good on it. Then you should have a fighting chance.
I like the word you use, responsibility, which is something that we often don't like to claim when it comes to our finances. But to come back to the issue of interest rates, for those who do want to consider it maybe just as a buffer or protective measure to ensure that they can still afford their home for the next 3 years or 5 years, depending on the term, are there additional costs involved when it comes to fixing the interest rate on your home loan?
Okay. So Gugu, no service fees or initiation fees or anything of the sort. I think the part that consumers have to probably grapple with a bit is that a fixed rate option is unlikely to save you money. That sounds like a controversial statement, but
yeah, I wish you saw my eyes pop open.
Yeah. So if you have to think, let's say you've got 100,000 rand now that you want to invest. If you go to the bank and you want to take out a year fixed rate or a 2-year fixed rate or a 5-year fixed rate, as the term goes out, you would expect a bigger and bigger return. I don't know if you agree with that. So unfortunately, home loans consumers that are looking to now borrow fixed from the bank is on the opposite side of that equation. So whereas an investor, you expect bigger returns the longer you give your money to the bank for, the home loans fixed rate customer is on the exact opposite side of that. So on average, you're going to pay more. Even if you call the cycle right, there are some customers obviously that end up paying less.
But what about for those payers who are actually quite good and manage to contribute slightly more than just their expected mortgage amount, and maybe throw in a couple extra thousand, or even just 10% more? Do they have any leniency or negotiating power when it comes to maybe seeing a reduction in their interest rate, and even being able to access that extra money later on should they need it?
Yeah, so Gugu, what you've described there is really good behavior from customers. So from a bank perspective, we use credit scorecards that basically look at a customer's entire credit record and calculates the likelihood of this customer paying back any loan that you were to give to the customer. And behaviors like that, where customers pay more than what they required, is something that we consider quite favorably on our side, because not only are you able to make the payment on every single month, you're able to pay more. So that's something that puts you in good stead, whether it's negotiating interest rates or loan features. So often those kind of customers also get given higher loan to value ratios. So if you're one of those good customers that have an unblemished credit record and you've got a track record of paying a little bit extra every month, the day that you come for a home loan, your likelihood of getting 100% of the value of the property as a loan is quite high.
Sure.
And the interest rate of those customers are typically quite a lot better than customers who only make the minimum installment. Obviously, that's still a good thing. If you make your minimum installment without ever missing a payment, that's certainly a good thing. Much better than only paying haphazardly. But if you were able to demonstrate that you're able to pay in a little extra every month, it shows the bank that you can live within your means. You've got that additional cash flow to perhaps take on some further debt. So it's certainly a good thing.
Exactly. So it pays to pay a little bit more, like you say. Let's get a quick recap now on the key takeaways from this discussion. Tommy, we've certainly said quite a bit in tonight's conversation, but for the viewers watching at home, what do you want them to remember about potentially fixing or not fixing their interest rates?
Gugu, I think for me the main thing would be prepared to potentially pay a little more. For every one customer that pays less, I can guarantee you there's at least 2 or 3 that's going to pay more on average, when taking out fixed rates. So I think be prepared to pay a little more, but really see it as a way of insuring yourself. Insuring yourself against future interest rate increases that could potentially put strain on your household finances and even forbid actually lead to you losing the property. So I would say if you know that your finances aren't that resilient and you get the offer to fix your rate at let's say 1 or 1.5% higher than your current rate, it might really be a good idea to take it up.
But like you say, ask the relevant questions, do your homework, and ensure that you can actually keep up with the payments.
Absolutely.
Tommy, thank you so much for your time today. Great speaking to you as always. That's where we leave it for Personal Finance tonight. A big thank you to Tommy Nel. He is in charge of credit and pricing at FNB Home Loans. Be sure to get in touch with us. You can tweet any of your comments to @CNBC Africa using the hashtag Finance410, or to myself @Gugulethu on Twitter. Until next time, it's goodbye for now.